Hey guys, Alex Late here with Trentry Mortgages, just with a quick 60-second Monday market update. Just going to talk about a little bit about what everybody's chatting about, which is interest rates. There was another Bank of Canada interest rate increase on December 7th. I thought, you know what, it's probably a good idea to dive a little bit deeper into the statistics, actually figure out what's going on. Can we sort of predict what's going to happen in the future? So if you believe that history repeats, or at least rhymes, this video is for you. First, how much did the Bank of Canada increase? They increased by 0.5% up to 4.25% now for the banking overnight rate. How does this relate to what we've seen in the past? In 1980s or 1970s leading up to the early 1980s, we saw massive inflation. Massive inflation was mainly due, surprise, surprise, due to oil prices and food prices skyrocketing. Due to a lot of various factors. Oil prices in Canada, the exports were increasing dramatically. Revolutionary war in Iran caused oil price surges all over the world, sort of what we're seeing with Russia and Ukraine right now. And so that actually led to some historic inflation. Inflation numbers back then were a little bit different than they are today. We saw them being around at the highest 12.5% in 1981, the lowest 4.83% in 1971. So when it first started increasing in 1973 at 7.8%, the highest we saw was 1981 at 12.5%. And then what we noticed from here was that the Bank of Canada started to raise interest rates to try to combat this inflation. They were just really following what the Federal Reserve was doing in the United States. Paul Volcker, well-known Federal Reserve chairman at the time, famous saying, the economy got Volckered. Basically what it means is they raised interest rates so much to sort of kill the economy. From our chart here, what you'll notice is that I just made a quick chart. I want to do some sort of analysis as to data that we've seen in the past and how we can relate it to today. So I pulled data from 1971 up to 1985, and we actually do start to see interest rate increases in 1977 or the end of 1977 all the way up until 1980, and then after 1980 we start to see some decreases. So what are the similarities to today? Essentially, today we've seen in 2022 8 rate increases going from a banking overnight rate of 0.25 to 4.25, which is huge, right guys? So this is actually an increase of 1,600%. Back in 1978 to 1981, where we saw the major increases, as you see in this chart, we saw an increase in the overnight rate from 10.5% to 20.78. So it does seem like a large number, and it is a large number, but we have to factor in on a percentage basis how much is this actually. On a percentage basis, this is only actually 97% increase. So 97% then versus 1,600% now. Put this a little bit in context. A loan, 1978, let's say it was $50,000. Obviously with inflation, loans now are a lot higher. So let's say a mortgage loan, $50,000, payment would have been $472 per month. After the increase to 20.78, loan payment would have been $870. Now, just put a little bit more context, average household income at that time was $53,000. Okay, whereas compared today, let's say average mortgage loan is about $500,000. Let's say somebody had a 0.25% interest rate, even though that's not actually what you get, but that's what the Bank of Canada had set at. Payment would have been $1,700 versus after the increase to 4.25, it would have been $2,700. So about a $1,000 increase there. For the former one I just mentioned, about a $300 increase. But again, let's put a little bit more context. The household income today in 2022 is only $75,000. So it's only increased $22,000 in a matter of 40 years, essentially. That's not really much. So anyways, just that gives you a little bit of context there. So with all this being said, what does it sort of tell us? It tells us that if you believe that history rhymes, if you believe that history repeats, more likely than not, we are going to head into a recession due to the large interest rate increases, people being unable to make their payments, and even if they're not unable to make their payments, they're going to want to reduce spending, which makes sense, right? You can't afford it, so you're not going to go buy it. So we're going to see the inflation come down, and with inflation coming down, people are spending less. When people are spending less, companies make less money. When companies make less money, they lay off people, and the cycle repeats, right? People lose their jobs, then they can spend less again, so on and so on. What does the Bank of Canada do? They then want to stimulate the economy. They want to be able to make people, or at least the Canadian government. They're independent, but to an extent. The Bank of Canada wants to create jobs, so they will actually lower interest rates. And by lowering interest rates, the people will start spending again. Businesses will need to hire more people. Hiring more people will lead to greater spending. Okay, just a little bit of economics 101. So what did we see in 1980s, in 1970, 1980s? 1980s, we saw a interest rate increase from 1978 to 1981. From there, we saw interest rates actually fall from 20.78% to 16.33% in 1982, and then 1983 we saw them go down to 9.56%. So in a matter of 2 years, okay, in a matter of 1 year we saw them go down 4%. In a matter of 2 years we saw it go down pretty much 10%. So that's huge. That's huge. Went down 10%. So if we use this, and in that time we actually saw a recession in 1981. It was a shorter recession, but we did see a recession. So it could be said that interest rates were decreased first off because of inflation toppling over, sort of falling off, which it did massively. But it also could be said that the economy was sort of coming to a sputter, so they needed to reduce interest rates because we're in a recession. Now apply this to 2022. Right now the economy is looking hot. Unemployment's record lows. Can we sort of use this predicting the future? The answer is yes and no. Yes, we can expect the economy to slow down because interest rates are so high now. People can't afford certain loan payments. They can't afford maybe even their home payments. Auto loan delinquency is the highest we've seen since in a 10-year time frame. So right there, you're already seeing people be able to spend less. Inflation is already so high, people can spend less just right there. So we're probably going to start to see some economic slowdown. Will it happen in 2022, at the end of 2022 here? Probably not, because in December, people are spending for Christmas. Companies need to hire because people are spending. They need more employees on the floor. But in early 2023, January, February, March, we could really see spending sort of topple over. And at that time, if we do see spending topple over and we're seeing people lose their jobs, we're seeing delinquency rates increase, not only on car loans, but on mortgages, this is where we are gonna, see a big problem. And likely at that point, if we enter in a recession, a technical recession, we're going to see interest rates drop. And how much they're going to drop, I can't tell you that, but I can tell you if we start to see, not only if we start to see a recession, but if we start to see stagflation and worse, deflation, because people are not spending at all, we'll see interest rates drop huge. Because deflation is a lot of the time worse than inflation. As weird as it might sound, with inflation, at least you still have people getting jobs, increasing their wage, being able to move jobs to get a better wage. With deflation, companies are losing money, so they can't hire anybody. And in doing so, they are making less money, and then they really can't hire anybody. So just a cycle, a bunch of different cycles happening at once. Macroeconomics, every 10 to 15 years we see some sort of recession. It's just the way the market goes. But all in all, just from this data I've been looking at, again, if you do believe history rhymes or repeats, I use the 1980s because this is when we saw the largest amount of inflation. We're not seeing that inflation now per se, but we are seeing the largest amount of inflation at least since the 90s, at least since the 80s. So it's just a good place to start looking. If you enjoyed this video, like, subscribe, follow on YouTube. We have our Instagram, Tried and True Mortgages. We help people with home financing, mortgages, refinancing, equity takeouts, debt consolidations, you name it, all residential. We've helped over 100 clients just this year. So yeah, guys, have a great day, and thanks for listening. Talk to you soon. Cheers.